Also, also last week we discussed that if a trader is actually looking for a buy, where does he buy? We talk about the discount level, and then we talk about when a trader is looking for sales, he sells at a what? At the premium level. Also, there was another thing that I mentioned, that the fact that price is at a discount does not mean okay, you're just gonna buy. The fact that price is at a discount level does not mean okay, you're just gonna place a buying order. No, that is actually where you look for high probability buys. So you wait for price to come to the discount level, then you what? You start looking for your buying signals, like on the lower time frame, basically. That is exactly what we are trying to discuss, and vice versa for premium. You don't when price gets to the premium level, you don't just sell. You actually look. That's when you start looking for your selling setup. That's basically what last week was all about. So basically, this week we're going to be talking about the four possible states of the market. So market can only like the market actually can only be doing one of the four things at a particular time. It can't do two at a time. It can only do one at a time, the way the market was programmed. Okay. The first thing that we're going to talk about consolidation. Then we're going to talk about expansion. Then we're going to talk about retracement. And then we're going to talk about reversals. And then we're going to talk about how it actually looks like. And then a little about how to use this in the market, combined with, what we've already discussed. Then if time permits, I'm gonna like teach you like a particular strategy based on that you guys would have to back test till next year, because this would be the last class for this year. I'm rounding off for this year, and then I'm going to start teaching again by January next year, okay? Because we are already near Christmas, and you understand, guys. And then happy Merry Christmas and Happy New Year in advance. If you can hear me, AJ and SK and others. All right. So let's start from consolidation. The first thing I want you guys to understand about consolidation is that the fact every market move that you want to see starts with consolidation. Every new day should, unless it has consolidated before, most of the new data, most of the new day starts from Asian session. It should actually start from consolidation. Okay. So basically, consolidation is when market is in a state of equilibrium. That is, market is actually in a narrow range, just going up and down without, without going in a clear direction. Most people say, okay, when market is consolidating, that's when you do nothing because market is doing nothing. Actually, there is no such thing as market doing nothing. When market is consolidating, that is when the market is in a tight range, what is happening is that market is trying to build liquidity on both sides of the market. That is on the upside, that is the buy side, and then on the selling side. I'm going to talk more about that later. But basically, when the longer the consolidation, the higher the breakout, that is the larger the expansion. I'm going to talk about expansion shortly, but most people, there is a strategy, this retail strategy built around breakouts. That is when there is there's something about Bollinger Band. Probably you guys have heard about the indicator before. The tighter the range and then the longer the Bollinger Band, the what? The, the more expansion that we get. All right. But basically, the idea is that the longer the consolidation, it means market has built a lot of order and the market can break to anywhere it deems fit. Okay. So consolidation, consolidation is doing is that market is currently building order at that particular time. All right. So it's building order on both sides of the market, at the buy side and then at the sell side. So sometimes market will break to the downside first before going to the upside. That is capture both sides of the liquidity. Or market will just break in one direction. I'm going to teach you how to trade that one. Okay. So consolidation is just when market is actually, the market is not it's just in a tight range, just going horizontal. But that time, it's not as if it's not doing anything. It's actually doing something. What it is doing is that it's just building liquidity on both sides of the market, both the buy side and then the sell side. Then speaking of the second one, which is the second state of the market, is an expansion. This is when price breaks out of what? Consolidation. What happens is that the market makers are trying to show the direction that they want to go, which means if price breaks to the upside, okay, if price expands to the upside, there is a probability that, based on the context or the framework, there is a probability that, the market maker is probably trying to go that direction or trying to do another thing. What is the another thing that it is trying to do? Probably trying to capture the liquidity on that side of the market, depending on where the market starts breakouts. Don't worry, when we talk about the, all these turtle soup, Judas swing, all those manipulation, I'm going to talk about this expansion more. But basically, expansion is when market is no longer in a range, in a tight range. Market has already assumed a direction. All right. Then retracement. Speaking of retracement, when we talk about retracement is when the market itself is like trying to pull back, that is trying to correct some level of move. The purpose of retracement is to give market makers the opportunity to re-enter the market, that is reprice markets. That is the purpose of retracement. And then another purpose of retracement is to, when market reprice to a place of inefficiency. What is the meaning of inefficiency? Inefficiency means a place where price was not efficiently delivered. It means probably, I'm going to show you an inefficient market when we get to the chart, but basically inefficiency means a place where there is a lot of buys. They cheated the seller there. So market is going to have to sell back there so that market can be efficiently delivered. That is, there is a gap in the market. It means market is not efficiently delivered. So retracements often try to rebalance any imbalance that is inside the market. That is the purpose of retracement. So basically, if you're asking that, where is the market likely to retrace to? Number one, there are two places. It will be at number one, most likely the imbalance or the liquidity void, just to fill in the liquidity void till it gets to the equilibrium, or if we are talking about a buy, to the discount, or if we are talking about a sell, it is trying to retrace to rebalance and imbalance at the premium area. I'm going to talk more about that in the future, but basically retracement occurs when market experiences a temporary pullback within what? A larger trend. This is often seen as a buying or selling opportunity for trader who missed the initial move in the trend. That is, it's a point, that is, it's one of the things that when market pulls back, the market maker tries to reprice price, and then they can bank on the next move that they want to do. Then also, we'll talk about reversal. Reversal is the complete shift, complete reversal of a trend. All right. But there is something I want you to write down. There is something I want you to note, that before any reversal can happen, there must be a measure of like ungodliness, that is a measure of mischief, which we call manipulation, a measure of what? Liquidity capture, stop ons, like anything mischievous in the market, but basically just to capture liquidity. So basically, before a reversal can occur, there must be a measure of what? A measure of liquidity capture. All right. So basically, that is one thing I want you to note. Now, you see these four states. Markets, you can be better at one. You can know how to trade retracement better than reversals. Personally, I'm not better at four. I'm better at trading reversals and then consolidation and a little of retracement. But expansion is what I'm still trying to get better at. But basically, what I mean is that you don't have to get good at all. You can just choose your poison. Choose one thing that you know how to trade very well. Probably reversal. Whenever you see a capture of liquidity, I know that, and I know how to do that one very well. And then I know how to trade consolidation, but not consolidation itself. I don't trade the consolidation market. It's because I understand the basis behind consolidation. I want to see something happen, which I'm going to explain tonight. Before, like I trade, that's the reason why I trade consolidation. Expansion and retracement, I'm not really good at, but basically, I only use them on higher time frame. But basically, I trade only reversals and consolidation, basically. But I'm going to explain everything. Now, going back to consolidation, what do you look for in consolidation? The first thing we look for is that you want to look for the highest point of the range. When we are talking about consolidation, okay, I'm going to go to the second slide now, so you guys can actually understand what I'm saying. This is an example of consolidation. I hope you guys can see my screen. Here is an example of consolidation. Can you see how the market has been? Market is not going in a particular direction. It's just going sideways in a tight range. This is another consolidation. Here is an expansion. That is, markets broke out of what? Markets broke out of the range. Then another consolidation. Here is an expansion. Then another consolidation. The market is trying to reverse. Then consolidation. Then market reverse. Then market retraced. Something like this is what we call inefficiently delivered market. That is, can you see there is no wick beside this candle? The last week was here, and then the second week was here. There is no wick beside this particular gap that is there. There is no wick beside it. So markets did not efficiently deliver here because the only thing that was here is just buying candles. Nothing. Market didn't retrace and fill in these candles. So market retrace just to fill it in. Before continuing, this is just retracement. All right. So basically, here's another retracement. All these are retracements. Then we have an expansion outside of the range. All right. So that's basically how an expansion marks up. This is an expansion markup, but retracement is actually the market will always retrace to rebalance and imbalance. That is, wherever market was not efficiently delivered, market will try to what? Rebalance it. So basically, here is the possible state of the market. So now, going back to this, whenever we talk about consolidation, okay, if a market is consolidating, how do we trade it? Number one, we wait for market to break out of the consolidation. And then there is something called the equilibrium level. Most of the time, market will come to retest the 50% of that range. That is one thing about consolidation. Most retail traders trade this whenever they see markets breakouts, is either they put buy stop, depending on where the direction of the breakout, is either they put buy stop, but basically we are not talking about buy stop now. We are talking about the real institutional trading. Consolidation, we actually take note of the 50% level. That is the 50% of this range. That is the sensitive part. Can you see if I, like, when we get to the chart, you guys are going to see it. So the 50% of this place was where market was tested before going down. Then 50%, that's where we are talking about, the sensitive part. Because if I mark out the 50% of this and extend it into the future, that is exactly where this one reacted to. But this is just a picture, not a live chart. But we are going to a live chart very soon, okay? So when we talk about expansion, we want to talk about the order block that was left when markets started expanding. Like something like this. When markets expanded up here, this order block that was formed, I'm going to explain order block shortly, but order block is what, when market is expanding, order block is what markets react to, okay? And in terms of retracement, we talk about imbalances or FVG, that is fair value gaps. That is gap that were left by the market, okay? This was what market retraced to, the gap right here. Market retraced to the gap right here. The gaps are the one with a candle without wicks by the side, okay? Something like this. There is no wick. After this, can you see the place that this wick reached? And then the upper wick here, instead of market to have rebalanced here, that is cover this place with wick before it actually going up. Market has to rebalance it here. I'm going to explain more of that later in the future, but basically, this is the idea behind retracement. And then for, what's it called? For reversals, that's when we start talking about liquidity pools, whereby market pulls into probably an equal high and then reverse. But then I'm going to show you that in what? Inside the what? Inside the live chart. But basically, before I go to the chart, let me explain what I mean by an order block. An order block is a price level where significant buying or selling took place. So we have, this one is a bearish order block, which means, you know, remember in the first phase of this strategy class, I told you guys about engulfing. The engulfing candle actually would have a usefulness in the future. So this is an example of engulfing, but I don't want you to think like a little trader. This is an order block is actually looks like this. But there are two places where an order block can be. But the first thing is this kind of order block is always located at the extreme of price. I'm going to show you that in the future. The order block is always located at the extreme of price. And then we have bullish order block. This is an example of a bullish order block, also located at a low. This one also at the bearish is most located at an high, that is an extreme high. And then order block like this located is the last candle before that move, that bullish move happened. That is the last bearish candle before this bullish move started is the order block. And then the last, for a bearish order block, the last bullish candle before this bearish one started is what we call an order block. That is a bearish order block and a bullish order block. If you have any question, you can just drop it on the chat. All right. So if this is an order block, then we have another form of order block, but we don't call it order block, but it's also a block of order. It's called the breaker block. It's always located at the midpoint as equilibrium, or at, a breaker block, just like the name sounds, is used to break, is used to break all those support and resistance level. Breaker block are used for it. So this is an example. You see this block, this is used for continuation also. This particular block before the bearish move, this particular bullish candle before the bearish move started, is always used to break something, that is used to break structure or used to break out of a zone. And then we have bullish order block, bullish breaker block, which is also used for like continuation, that is continuation to the upside, which means price is trying to break an high. All right, when the market is trying to break a bullish structure, it will leave something like this, like a fingerprint like this. It's also an order block. Order used to break a particular zone, but basically we don't call it an order block. We call it a breaker block, but it's just another version of what? Another version of order block. What do I mean by order block? I'm going to recap. Order block is the last bullish, a bearish order block is the last, this last bullish candle before this last bearish candle that engulfed it. And then this is a bullish order block, this particular candle before the bullish move took place. And then a breaker block, that is a bearish breaker block, is the last bullish candle before this move happened. And then the bullish breaker block is the last bearish candle before this bullish candle happened. I'm going to show you an example in charts, but basically that's what it means. Then we have imbalances, just like I've explained. Imbalances are also called inefficiency or fair value gaps, that is, markets did not efficiently deliver. Mostly, this is how markets should move. Market should actually create a candle, then retrace it first before moving, continuing. That is, leave a wick beside it before continuing. But sometimes when the markets, probably during the times of news, there is something we call liquidity void, when market just went down in one direction without retracing. Like, can you see this candle? This candle has no retracement beside it before markets continue. So all this gap in the markets where there is no wick at both sides of the candle is called an imbalance, something like this. So it's a sensitive zone too that we mark out on higher time frame as our zone. Those are the kind of zone that we use in. Basically, those are the three kind of zone that I use. There are other zones that we are going to talk about probably in the future, but not in this foreseeable future. But basically, every other zones are built around this, like proportion block, mitigation block, all those kind of stuff are just built around these basic fundamentals of the market. That is the order block, the breaker block, and then the imbalance. All right. So I'm going to show you an example of like order block now. I told you that another block is mostly located at what? The extreme. So this is a bearish order block. Can you see this particular candle, the last bullish candle before this bearish move started is an order block. Mark it as your zone. Can you see that price will reacted to it in the future? Okay, this is an Euro USD chart. Then here is another example. This is another block. Can you see it's an engulfing candle? But basically, I'm not talking about the detail method. I'm talking about the view institutional method. This is an order block. The last bullish candle, this is a bearish order block, actually. The last bullish candle before what? Before the bearish move started. Can you see that price just reacted to it and then moved? Also, this is an example of a bullish order block. This one that looks like an engulfing candle. But price broke it, then retested it before going back down. Also, this one. Then this is an example of an imbalance. This particular gap that was inside this candle. What happened is that price retraced inside just to rebalance this one, just to create wick beside it before continuing. I don't know if you guys understand. This is an example of an imbalance. Can you see all these gaps starting from this place to the top of this place? Markets will retrace it in the future just to fill it in the future. Okay, so this is an example of order block. Then we'll talk about imbalance here too. Can you see? Here's an example. I've already spoken about it in the last slide, something like this. But basically, this is the imbalance because there are no wicks beside it. Okay, there are no wicks beside it. And then thirdly, there is another thing that I want you guys to see. Something like this in this candle. This retracement, just this small retracement, the purpose is just to refuel this, to just rebalance this imbalance and then continue. Although price might still come back then to future to balance it to like 50% level or balance it totally before continuing. But basically, when we talk about retracement, we are talking about price retracing to an area of inefficiency. All right. Then we have what? We have breaker blocks. This is an example of a breaker block. Can you see? This particular order block. Now, a breaker block can also be called like an inverted order block, but I would not talk about that now. But basically, there are two examples of breaker block, like the one that I showed you. This one, this type, or this type that was broken. This particular type, imagine it was broken to the downside. You still mark out this order block, but you don't call it another block again. You call it a breaker block. So basically, let's go back to this particular example. So this is an example of an inverted order block or a breaker block. This particular block, this order block that was used to break this place. This is another block. Price will be so sensitive at it in the future. Okay, so here is the breaker block, the typical one that I was trying to show you. Can you see this particular block of order? Before price broke this structure, what did price do? Price, bought first, then broke it. More like price pull back, then just to break this place. This particular candle is what we call the block of order. That is the order block, the breaker block that was used to break this place. Can you see that when price retraced back then in the future, price touched the mouth and then just reacted to it? Can you see this straight line that I drew? Basically, it's just a very sensitive area in price. You understand, right? You guys understand that. So basically, that is an example of a breaker block. Then also, this is like a data, like a lot of data, a sizable chunk of data. So let's talk about this. Then we have an order block here that price reacted to. I've already told you about price capturing liquidity, but we're going to talk about that later in the future. Then we have a breaker block here. This particular breaker block was used to break what? This particular area. Can you see this particular area, this zone? This breaker block was used to break it. Then when price came back there in the future, what happened? Price reacted to it. Then also we have another block here at the extreme. Can you see? Lower low, lower high, lower low, lower high. Order block again at the extreme. This is also an order block. This last candle before this bearish move happened. Price reacted to it. Price reacted to it here also. That is the basis for this move. Then we have another breaker block here that was used to break these two zones. Can you see? We have two things. Look at inverted order block, which is also a breaker block. I call it breaker block personally. And then we have the typical breaker block. All right. Then when price broke it, when price retraced back into it in the future, price reacted to it. That's it basically. Okay. Then can you see what broke this place? All this candle that happened, if you check it on higher time frame, it's just one breaker block. Do you get? But talking about structure, lower, then price reacted to this order block, this bearish order block, then went down. Then price reacted to this bearish order block to go up. So this is an example of what? Order block, breaker block, all this kind of stuff. Then, speaking of imbalance is something like this. Price just had to go up and rebalance it just a little before continuing. Okay, there are a lot of examples of price trying to rebalance. Let me show you something like this. After price created this and this place to this place is an imbalance. Then the next candle had to go down, rebalance it a little before continuing. So basically, that's what an imbalance is. I've already explained. I'll show you more example in charts. Okay. Those are the zones. If you want to mark out zones, those are the zones that we mark out. Okay. So by next year, when we start teaching again, I'm going to go in depth into smart money concept. But basically, this is like what's it called? I'm going to give you the strategy today, actually. I've already explained everything that I want to explain. Okay. Starting from everything that I've explained in this phase, this strategy, phase 2. There's phase 3. Phase 3 is the smart money concept. All right. I'm going to tell you much more about that in the future, in the next class. But basically, I'm going to build the strategy right now. What I want you to back test heavily. Number 1, drop all those the strategy class 1 that I taught you, all those retail method, 4/4, 5/5 method. It works for another asset class that we are going to talk about in the future, but I don't want to talk about that now. But basically, let's trade Forex. This is what I want you to back test for the rest of this year, and then build, when you want to start building your strategy, I want you to build your strategy around all these fundamentals that I've given you. So I'm going to be sharing another screen shortly. Okay, please let me know in the chat if you can see the screen. According now, if you can see my chat. Let me know if you can see the chat. Just drop it in the chat if you can see the chat, like my chat. All right, AJ, thank you. Now, let's use the most traded currency pair. Let's use Euro USD for an example for this particular teaching. Okay. Now, speaking of premium and discount, remember the first thing I told you was liquidity capture. Then we went to some other stuff. Then we talked about premium and discount. Okay. So here is an example of the market trying to retrace. Trying to retrace into the equilibrium level, then trying to buy, which is the main reason why I've been actually looking for buy on Euro USD, basically. Like all the things I've not been trading actually, but basically if I've been trading, I'll just have been looking for buys when price got here. Let me show you something. The reason why we were able to know that, apart from fundamentals, the reason why we knew that, okay, the FOMC is most likely going to go up, but even if they leave rate uncut, based on expectation. Like, let me put a line on this particular place. There's actually something called a swing. A swing is, probably you guys have heard about fractals indicator. The idea is just to show you an example of a swinger. But basically, how we define a swinger is when one candle, this candle has lower low and lower high between both sides. Can you see? This candle didn't close below this, and then this candle is not lower than this. So this place is a swing. Also, this is an example of another swing. We have one candle that has lower low on both sides. Can you see? This candle did not wick out this candle's high, and then this candle's high is lower than the last candle's high. So we have a swing here. Can you see that we have a swing here again, which means price is almost about to go up. And the swing is characterized by 3 candles or 4 candles. Let's use 4 candles. This particular last candle, then this candle, then one more candle that did not close below this candle. That is, the low of this candle did not close below this candle. Then the 4th candle just shows that market is about to turn bullish, just at the equilibrium. Which means when price got to the equilibrium, I don't just start looking for buys blindly. I wait for more confirmation. Like, I've seen the swing. Can you see the swing? Then after the swing, then we can actually start expecting market price to buy. All right. Then let's go to let me go to 15 minutes. Let me go to 15 minutes. I'm going to go to 15 minutes now. And then I want to show you 5 minutes, sorry. And then I want to show you that particular area in chart. After the swing happened, this was the day that the swing happened. This particular line is used to delineate that area on the daily chart. Sorry, guys, it's the network. All right. So basically, after I saw the swing, like that swing on daily, this particular day, I will just be looking for buys. Then what characterizes my own buy is just, number 1, what I want to see is a capture of liquidity. And then how does a capture of liquidity look like? Number 1, first thing, the strategy I want to give you actually, which we are going to backtest. I'm going to explain it shortly, but basically, this is a consolidation. Then price captured liquidity right here. Then let me run on sell side. Right here, sell side liquidity was purged. Then lastly, price broke structure, then retraced inside it. Then this is where we buy. That was how I knew that most likely price would, technical wise, that price would go apart from fundamentals. We knew price was going to just shoot high on that night of FOMC 8 o'clock. Okay, apart from fundamentals, this is just technicals. So going back to the daily time frame. There is something like, there is a strategy that I want you guys to actually learn. Number one, this is it. If you see a liquid area like this, that is, a market creates an equal highs, then the next thing you want to see is that you want to see price take it out. That's the first thing you want to see. Let price take out this equal highs, then you go on the lower time frame to look for structure. That is the intention of price to go down. Do you get? Like I taught you in the first strategy class, you want to look for lower time frame confirmation that price is actually ready to sell. Then you sell. I'm going to explain again. But basically, that's smart money. But I want you guys to backtest it before we what? Before we get into smart money. Let me show you an example on chart. There are two things that I want to teach you. Two strategies I want you guys to backtest. I'm going to upload this video. But basically, let me try to explain what I mean by that. Let me go to 15 minutes so it can be more clearer. I'll go to everyday chart so you guys can see what I was saying. So basically, what I want to see, number one, is what? A capture of liquidity. How does a capture of liquidity look like? Looks like, look at this. Market had already gone higher. Do you get? This particular higher, which means some people would have moved their stop loss below this low. Some people that are trying to buy, they will set their stop loss below this low. Then what happened was the fact that market captured it. Market created this, the market captured it. So this is something I would delineate as run on sell side. Then after sell side liquidity was purged, market started showing intention of going up. Then again, on the next day, market captured liquidity again. Can you see this relatively equal highs and low? Equal lows. Market took it out. Then gave me a little break of structure. Then basically, how do you know? There are two ways to know a break of structure. Number one, you can know it like this. Like just within the normal structure. Something like this. Do you get break of structure? But there is another way to know it. We don't need to know a break of structure sometimes. All we need to see is imbalance, that price just reverse. On the lower time frame, you just shoot up and then leave imbalances. So remember what I told you about retracement. Retracement will be like this. Market will retrace inside the imbalance before continuing. Like something like this. This particular, I'm going to increase the size. This particular area, after the capture of liquidity, this particular area, you don't just buy after capture of liquidity, okay? You wait for price to give you the signature that I'm talking about. That is, you wait for price to actually show you that it's ready to go up. Then price shot up and then created this imbalance. I'm coming. Let me delineate it with white so that you guys can see what I'm talking about. I hope you guys can see it. I'm talking about this imbalance that was rebalanced. This one, this small gap that was there that price didn't refill. That was what, can you see price just reacted to it? Didn't close, just try to create wick right there before continuing. Okay, so basically that is what I want you guys to note. Number one, the first step of this strategy is that you want to see market capture liquidity. Then after market dipped into that liquidity, you want to see a shift in market structure. That is, market, number one, is either market break structure to the upside, and then you look for retracement into an imbalance. or market show a big willingness to move. Let me show you more example, but then let me go to another pair. Probably this one is, let's go to another pair that we don't really talk about, like USD card. All right, let's go to USD card. So we are going to check some of the price action that happened of recent and try to make sense of everything. So number one, here is the capture of liquidity, but market didn't give any chance of entry. But there's still a way to catch this later in the future, which I'm going to tell you when we get to liquidation and mitigation, okay? But basically, let's look for good examples. Also, this one is about the second strategy, but basically, let's drop that for now. Let's look for typical examples. The network is kind of crazy. All right, something like this, actually. Something like this. Our market will rebalance. All right, here. Then we incorporate timing too. Please do not forget that. We incorporate timing. Personally, I wouldn't have taken this trade because it's even outside of London session and everything. So, but basically, let me explain the strategy first, then I will combine it all together. The first thing you want to see is what? Market taking out an eye. Depending on the trend. Let's assume this market is a what? Is a downtrend. Okay. The network is crazy. That's the reason why the chart is moving on. So, okay, I think it has settled. All right. The network is bad. I'm sorry. Apologies. Okay. Now, see something like this. Let me just use this as an example. We have two examples here for right here. Number one is this. All these equal lows that was captured. Okay. Then I will deem this as what? Run on sell side. The reason why I'm just kind of just giving you the overview is because this is smart money concept. I've not explained it at all to you. Okay. I've not explained it at all to you. I'm still going to explain in the next strategy class. I just want you guys to like back test it before the next class starts. Okay. Then after price dipped into this liquidity, if we search here on the lower time frame, you will see that okay, after this, we had a break of structure. On the lower time frame, market broke structure. This number one, we have an imbalance right here, just a small imbalance. The market went up, down, then on lower time frame, if I check this side on lower time frame, you would see the particular stuff that I'm trying to say, the shift in market structure. That is high, low, then another high. That's when we start hunting for buys. Okay. Then here is another example where price captured a lot of highs. Right here, this high and then this high. Let me just mark one out. Where markets, then I'll call this a run on buy side liquidity. Then after price captured that run on buy side, can you see the high I'm talking about? This particular high. Stop losses will be above and buy stops will be above. Then markets broke structure right here. After markets broke structure, what happened? Retraced inside it till the next day before what? Pricing down. Okay, before pricing down. Now, here comes the real one based on the strategy of today. Is number one, I want to incorporate timing, session, accumulation, the first state of the market based on what we've been building on this strategy. The first thing is you want to know about the daily profile. Most of the time, most often than not, okay, every day, that is during Asian session, we should have consolidation. Okay, consolidation. I think I've done something like that today. Let me show you guys. If I can still see it on this chart, then I'm going to explain. It's going to make sense to you guys. I've done something related to that today. When I was preparing this lecture, I'm hoping it's this. Okay, so basically every day starts with consolidation. Then after consolidation, we can expect an expansion. Then there are two purposes of an expansion. The network is bad, sorry. There are two purposes of an expansion. Is either price wants to continue moving in that direction, or that expansion is actually to do what? To capture liquidity. Okay? Please, guys, hold on. Or to capture liquidity. Sorry for the poor network tonight. It's just... All right. Let's just look at today's price, yesterday versus today's price action. This particular chart. The purpose of the basic stuff behind this trade is what I'm going to explain right now. This one, remember, before any reversal can happen, there must be a measure of liquidity capture. Basically, before any reversal can happen, what should happen? There must be a measure of liquidity capture. The idea behind this trade is just this. This is what I'm trying to explain. I've already, the market is bullish, basically. But to actually catch it, I can't just enter the market and buy. What I do is just that. Mark out this place as what? My capture of liquidity. Run on sell side. Okay. Sorry. I'm talking about this guy right here. Run on sell side. Then after price captured liquidity here, every stop loss is here. That is equal lows. What happened? Market created something that I want you to see, an imbalance. Hold on, guys. Can you see? The imbalance is just what I marked out. Then market came back to retrace. You know, reversal, before a reversal can happen, what happens? Market must capture liquidity. Then after price captures liquidity, what are you expecting? An expansion to the what? To the upside. Then after an expansion to the upside, what are you expecting? Retracement into what? Into an inefficiency, which is what I'm expecting. I'm just expecting all these market movements. Market retrace into an inefficiency, then expanded upwards. Do you guys understand? Consolidation, the market captured it, took out liquidity, that is expand to the downside just to take out liquidity, which means reversal is probably imminent. But how do you confirm that your reversal is imminent? Is when markets start pricing upward, leaving an imbalance, that is inefficiency, showing that there is strength to the upside. The market reacts to it and then goes up. Then this particular day, what happened? After consolidation, what did market do? Market opens up to the upside. Then what did I tell you about consolidation? You mark out the what? The 50% of that range, the middle of that range. That is around here is the middle. Do you get? The market to come back to it. And if market expand, all you expect is for market to what? To come back to what? To come back to the other block that was left at the expansion side. What did market react to? Market react to the other block that was there. Also confluencing with the midpoint of the what? Of the Asian range. Now also confluencing with the time. Remember, like the reason why I took this trade is because it's around London session. Okay. Also this one, London session. Every blue line that you see is London session. That's the reason why for this one, it never ATP. It eventually broke even. Okay. Then let's go to another day. What happened here? Okay. You need to see the bigger picture before we can make sense of it. So basically, the day started like this. This particular day, sorry, I want to zoom in. Started with what? Consolidation. Anytime I see Asian consolidation, that is Asian range, I'm always happy. Because number one, I'm expecting two things. The first thing I'm expecting is that probably price wants to capture liquidity or price wants to expand, manipulation or an expansion. Then I mark something like this out. I mark it out in red. Hold on. Red. All right. Then what happened? Market didn't capture liquidity because it had already done that. Then after the consolidation, what happened? There was an expansion. Expansion, that is a break outside of that range. Consolidation, expansion. Then after expansion, there are two things we can expect. Retracement inside this FVG, that is inside this imbalance. If you guys can see the imbalance very well, this imbalance that is here, or remember the 50%. The 50% level, that's the maximum place it can reach if price is meaning to go up. Then after that, the other block that was created, this is the last candle before this move started, the last bearish candle. Then price reacted to it and then started pricing upwards. Okay, from consolidation to what? Consolidation to expansion. Then after expansion, there are two purposes of expansion. I'm looking for the second scenario. Actually, yeah, I've seen the second scenario. Something like that. That was actually last week, Friday. What happened was that when the market opened, market started consolidating. Let me show you the consolidation. The consolidation was here. Remember the first state of the market. The consolidation was here. Doing what? Creating equal highs right here. Then if equals are created, if market can capture it, it means market is most likely going to reverse. Okay, then market did what? Market captured it. Market captured it. And then market started pricing downward, reversed. From consolidation, then market expanded upward just to capture liquidity. If it were another scenario where market expanded upward, I would have tried to buy from the midpoint or this other block. But basically, because I saw this capture of liquidity, I would just be looking for the reversals. Okay, here is another one. I'm trying to, make sense of it all. Here's another one. Asian didn't range. Nothing happened during this day. But basically, what happened was the fact that market was just trying to retrace, that is, rebalance every inefficiency. That was what market was doing. Right here, market was trying to rebalance this inefficiency. Then during New York session, market tried to rebalance this inefficiency, this imbalance. I want you guys to work more on that. Okay, so that is basically everything that you are doing. You are just trying to look for like every characteristics of those markets. That is what I've spoken about, the consolidation. Then what happens after consolidation? What happens after price expand? What does price react to? All those kind of things is what you want to backtest. Okay, and then by next year, I'm going to go deeper into it when I go into smart money concept. Then you incorporate your time, because timing is very, very important in the market. Timing is very, very cogent. You don't just expect all these things at any time. You expect them at some critical time. Do you get? Can you see when all of these moves were happening? It's happening during the Q zone. Remember what I told you about those? Is yellow. Yellow means Asian. Blue means London. This red means New York session. That is New York Q zone. Overlap most likely. And then this blue means London close. So all these time are very, very important. All right. Look at this consolidation. Let's talk about this consolidation. This particular consolidation. Then after the consolidation, what happened? Price expands to the downside. Okay. After price expands to the downside, what did price leave there? In an expansion, what do we pay attention to? We pay attention to the other block that was left at the equilibrium. Okay, this particular other block. Then price touched it and then went down that day. And then basically it was used to capture liquidity. Then let me go to higher time frame. Then show you more example on higher time frame, because price is fractal. Price is fractal. So let's see if we can, all these things that we are seeing on lower time frame, can we see them on higher time frame? How do I determine swing trade? This is an example of what I want to show you. I'm coming. Now, swing trade. Number one, look at this. If you can see what I'm seeing first. Hold on. There is something I want to mark out right here. What happened? Capture of liquidity. Can you see? Capture of liquidity. But before the capture of liquidity happened, something happened. Market did what? Markets consolidated, then captured liquidity, then went up, broke structure. But there is something, this is daily time frame. There is something I'll be expecting. You see this last move, before all this bullish move happened, is what I will call what? My order block. The order block. Okay. This particular candle is the order block that I'm talking about. Then also, this candle, when it starts pricing upward, left what? Imbalances. So those are two zones conferencing at one point, which makes this place very, very strong. No wonder price just touched it and then started pricing upward. Basically, that was what happened. Then also, of recent, all these moves of recent, let's even talk about it. Number one, the first thing we consider right here is what? We consider the premium discount. After price broke this structure, then bring your Fibonacci. Anything above is what? Premium. Anything below is what? Discount. Then where do you buy? You start buying from equilibrium, but you don't just buy. What do you wait for? You wait for market to shift. That is, you want to see the sign in the market. The market is ready. Then what happened? Market did what? Market captured liquidity. Right here and also right here. All this liquidity captured. Then what happened? Market expanded to the upside again. Do you get? You start buying from around here. That is, when you're looking at it from higher time frame, you start all the trade that you want to take on lower time frame. That is, before I can drop down to a lower time frame, I'm already thinking about all these things on the daily. That is, I'm expecting market to start pricing upward. You will never ever see me look for sell on the lower time frame once I decide the market is about to buy. Okay, now let's draw another Fibonacci from this low to this top. Most people will start looking for buys right here, but remember, I told you, you don't look for buys at premium. You look for buys at what? Anything below the 50% retracement level, which is the discount. Then what happened is swing. That is, this candle has higher highs above side. That is, this high, this candle's low is not lower than this, and this candle's low is not lower than this. That means we have a swing. Then I can expect that the next candle will just expand. Do you get? Then the next candle rebalanced the imbalance, retraced inside the imbalance, and then went up. Even this particular move, let's measure it from this place to this place. Once you start buying from here at the premium, it's not of high probability. You only get your best buy, that is high probability buys at what? At discount. Then you combine it with your timing, then you combine it with your what? With your capture of liquidity, and then the shift in market structure. Okay, all these things is what you are going to backtest one by one, then build a strategy around it. Okay, do you guys understand that everything that I've been talking about since morning? So for recap, I'm going to go back to the slide just for recap. Sorry, I have a question. Hold on, just give me 1 minute. Let me close this particular meeting and then stop recording. We have 4 states of the market. We have consolidation. Consolidation is when price is in a tight range. We have expansion. Expansion is when price breaks out of what? Consolidation. We have retracement. Retracement is when price is trying to reprice and rebalance any imbalance. And then we have reversal. Reversal is when price reverses a trend. And then when we see consolidation, what we consider is the equilibrium. That is the 50% of that range. And then for an expansion, we consider the other block that was left at the near or at the equilibrium. That's the zone that we mark. And then for retracement, we mark out what? Inefficiency that was there. And then for reversal, we want to see what? Liquidity capture, all these stop runs. That's basically what we want to see. Okay, so I'm going to stop recording and then I'm going to entertain questions now.